Markets move because money moves, and money moves for a reason. Follow the money. Every machine has one requirement. It must keep moving. A train needs fuel. An aircraft needs lift. A business needs customers. And a financial machine needs capital. That simple idea explains almost everything about strategy. From the outside, it looks straightforward. The company raises capital. It buys more Bitcoin. Its Bitcoin holdings grow. Investors become interested. More capital arrives. Then the cycle begins again. Over the past several years, this process has repeated itself again and again. Each successful financing made the next one a little easier. Each additional Bitcoin purchase strengthened the company's identity as the world's largest corporate holder of Bitcoin. To many investors, it looked unstoppable. But every successful system contains an assumption. Not always an obvious one. Sometimes it remains invisible for years. The assumption here is simple. There will always be another financing, another investor, another offering, another opportunity to raise capital. As long as that remains true, the machine keeps moving. Bitcoin does not need to be sold. The balance sheet continues expanding. Time stays on the company's side. But financial history offers an important lesson. Markets rarely fail because they suddenly run out of ideas. They usually fail because they gradually run out of liquidity. That difference matters. Because liquidity is difficult to notice while is abundant. Everyone notices it only after it begins to disappear. So before asking whether strategy might ever sell Bitcoin, there's a more important question. What happens if the money simply stops arriving? That question does not begin with Bitcoin. It begins with capital markets. And once capital stops moving, the entire system begins revealing how it was built. Now, let's change just one assumption. Bitcoin does not collapse. It simply stops rising. Investors become more cautious. Capital markets remain open. But enthusiasm begins to fade. No panic. No crisis. Just fewer investors willing to write the next check. Imagine that for the next 12 months, strategy raises no new equity, no new preferred shares, no new convertible notes. The company doesn't lose its Bitcoin. It doesn't sell anything. It simply stops receiving new capital. At first, very little changes. Employees still go to work. The software business continues operating. The Bitcoin remains safely in cold storage. From the outside, everything looks normal. That is often how financial pressure begins. Not with headlines, not with panic, but with silence. 1 month passes, then another, then another. The balance sheet doesn't ask whether Bitcoin is popular. It asks a different question. How long can existing resources support the business without new money? That is the beginning of every stress test. Because once new capital stops arriving, time starts becoming part of the equation. And from this moment, every month begins carrying more weight than the month before. Now, the balance sheet begins telling its own story. Every public company operates under one rule. Cash doesn't last forever. Operating expenses continue. Interest payments continue. Administrative costs continue. Whether investors feel optimistic or pessimistic, those obligations do not stop. That is why time becomes so important. As long as new capital arrives, the clock moves slowly. If financing pauses, the clock does not stop. It simply becomes louder. This is the difference between a market problem and a liquidity problem. Markets can recover. Liquidity depends on time. Imagine that several months have already passed. No new financing. No additional capital. Management is no longer asking how much Bitcoin the company owns. The question gradually changes. How much cash remains available? How much flexibility still exists? Every month, without new funding, reduces future choices. Not because the business has suddenly failed, but because financial flexibility is becoming more limited. This is how pressure usually develops. Quietly, gradually, almost invisibly. And by the time everyone notices, the clock has already been running for months. At that point, time itself becomes the company's most valuable resource. Now, let's stop talking about theory. Instead, let's run a stress test. Not a prediction, not a forecast, a scenario. Assume Bitcoin trades around $55,000. Not for 1 week, not for 1 month, but for an entire year. Now change one more assumption. Capital markets become far less willing to fund new offerings. Not completely closed, just much more selective. This matters because strategy doesn't rely on one source of financing. It has used common equity, convertible notes, and preferred stock. Each financing tool depends on investors choosing to participate. If demand becomes weaker, raising new capital may become more expensive or less frequent. That does not mean the company immediately faces a crisis. It means management has fewer choices than before. Imagine 3 doors. The first door is raising new capital. The second is using existing liquidity. The third is selling assets. When markets are healthy, the first door usually stays open. If financing slows, management may begin relying more heavily on the second. Only if both of those options become increasingly limited does the third door enter the discussion. Notice what we did not assume. We did not assume Bitcoin failed. We did not assume the company failed. We only assumed that raising new capital became more difficult. Sometimes that alone can completely change how a balance sheet must be managed. Because every financing strategy depends not only on assets, but also on access to capital. And once that access becomes more limited, management must begin making very different decisions. At this point, the conversation begins to change. The question is no longer whether Bitcoin has fallen. The real question is how management responds when financial flexibility becomes more limited. Public companies rarely begin with their most extreme option. They begin with the least disruptive one. First, they slow down. Expansion plans may become more conservative. Future purchases may happen less frequently. Next, they look at financing. Can existing debt be refinanced? Can new investors still be found? Can capital be raised under different terms? Only after those possibilities become increasingly limited does management begin evaluating more difficult alternatives. That does not mean a decision has already been made. It means every available option must now be compared. Protecting liquidity, reducing obligations, preserving flexibility. Those priorities usually come before selling long-term assets. That is why asking, when will they sell Bitcoin, may actually be the wrong question. A better question is this: how many other choices still exist before selling assets becomes one of them? Every closed door changes the value of the next one. Every month without new capital reduces management's flexibility. And every decision must balance today's liquidity against tomorrow's opportunity. In financial markets, selling assets is rarely the first decision. It is often the decision that remains after many others have already disappeared. Let's return to the question we asked at the very beginning. What happens when the money stops? After everything we've examined, the answer looks very different. The first problem is not Bitcoin. It is not debt. It is not panic. The first problem is that choices begin disappearing. Every company depends on flexibility. The ability to borrow, to refinance, to raise capital. As long as those choices exist, management has time. When those choices become fewer, time begins moving faster. That is why this story has never been only about Bitcoin. It is also a story about capital markets. Markets decide which companies can keep growing. Markets decide who receives new capital. Markets decide which opportunities remain alive. Strategy is only one example. The same principles apply to thousands of public companies. The real asset is not always cash or Bitcoin. Sometimes, the most valuable asset is access to capital. And once that access becomes more difficult, every decision begins changing. Not all at once. Quietly. One decision at a time. The balance sheet doesn't predict the future. It simply tells us how much time is left before another decision must be made. And in capital markets, time is often the most valuable asset of all.